Welcome back to Market Pulse. I'm looking at the Shanghai Composite, and folks, if you want a masterclass in policy-driven volatility, this is it. We've seen this index go through the ringer since the mid-2000s, but the technicals are telling a very specific story right now in early 2026. Let's pull up the chart and break down the legendary peaks, the brutal, lost years, and why we're currently seeing a Phoenix rally. The historical roller coaster, 2005 to 2015. 1. The Great Bubble, 2006 to 2008. Look at this vertical move. This was the era of China Inc. arriving on the world stage. We saw the index skyrocket from 1,000 to an all-time high of 6,124 in 2007. It was pure euphoria, but the 2008 financial crisis acted as the pin to that bubble, causing a 70% crash. It left a generation of retail investors scarred, and frankly, we've been living in the shadow of that 6,100 peak for nearly 2 decades. 2. The Leveraged Frenzy, 2014-2015. Flash forward to 2014. The government wanted to help state companies deleverage, so they essentially encouraged people to buy stocks. We saw the index double in a year, hitting 5,178. But the technicals were hollow. It was built on shadow-financed margin accounts. When regulators pulled the plug on that leverage, we saw a 30% drop in just 3 weeks. It was absolute carnage, leading to a total market freeze. The modern grind down, 2018 to 2024. 3. The trade war retrenchment, 2018. Then came 2018. This was a textbook bear market triggered by external shocks. The US-China trade war hit high gear, and combined with Beijing's internal deleveraging campaign, the SSE Composite shed 25% of its value. We saw lower highs and lower lows all year as liquidity simply dried up. 4. The structural reset, 2022 early 2024. This was the most painful period in recent memory. We call it the triple threat: the property bubble popping, the tech regulatory crackdown, and the zero COVID drag. By early 2024, the index capitulated, dipping toward 2,700. Foreign funds were fleeing for India and Japan, and it felt like the floor was falling out. The 2026 Policy Phoenix Outlook. But look at the right side of your screen now. The bazooka stimulus of late 2024 changed the game. Beijing pivoted from letting it burn to buying the dip with massive central bank liquidity. As of January 2026, the SSE Composite has been fighting its way back, currently testing the 3,900 to 4,000 zone, levels we haven't seen consistently in years. Here is my technical playbook. The technical levels to watch. The 4,000 ceiling, this is the massive psychological resistance. We've had a 9-day winning streak recently, but to turn this into a secular bull market, we need a weekly close above 4,000. The 3,200 policy floor, the national team, state funds, has clearly marked 3,200 as their line in the sand. Any dip toward that level is being met with aggressive state-backed buying. Style rotation. We're moving away from old China, banks, property, and into new quality productive forces. Keep your eyes on the Chi next, the Nasdaq of China, and AI, semiconductor plays. They are the ones providing the alpha in this rally. The bottom line, we aren't in the Wild West of 2007 or the margin trap of 2015. This is a disciplined, state-guided recovery. For the bulls, the trend is your friend as long as the PBOC keeps the taps open. For the bears, geopolitical risk and profit-taking at the 4,000 mark are the big hurdles.